Think about the last time the market dropped and you felt it. Maybe you pulled up your phone, opened up your brokerage app, and watched the number go red. You weren't panicking. You're too experienced for that. But there was tension, a quiet voice that might have said, should I do something? And that tension isn't an investor flaw, but it is a signal. And in most cases, it's telling you something very specific about how your portfolio is structured, not how the market is behaving. Here's the principle that I want you to walk away with today. If your portfolio needs calm headlines to work, especially in today's media day and age, then it isn't built right. The goal here is not a portfolio that never drops. The goal is a portfolio that never forces a bad decision when it does drop. In a moment, I'll show you the one structural mistake that makes every scary headline feel bigger than it actually is. And I'll walk you through the exact framework that we use to build portfolios that give high earners something that's genuinely rare in volatile markets: clarity, control, and the freedom to let the noise be noise. Here's what most people assume when markets get volatile: that the stress is caused by the market drop. So if you fix the market, then you ultimately fix the stress. But that's not what's actually happening. I talk to executives every week who have well-diversified portfolios, solid long-term track records, and they still feel a knot in their stomach when things get choppy. And when we dig into it, the root cause is almost never the market itself. It's a specific mismatch. A mismatch between when they need the money and how that money is currently invested. Think about what that actually looks like in real life. You've got a college tuition bill coming in 18 months. You're planning a significant home renovation next spring. You've quietly been thinking about stepping back from your current role in the next few years. And right now, all of that money, the near-term stuff, the medium-term stuff, and the long-term compounding money, it's all sitting in the same general portfolio. No clear separation and no job description tied to each dollar. So when the market moves, every part of your financial life feels at risk simultaneously. And that's when the wrong questions start showing up. Should I hedge this? Should I move to cash? Is now the time to change my allocation because of what's happening in the world? These are expensive questions, not just financially, but cognitively. And for someone running a team, managing a career, raising a family, you don't have unlimited mental bandwidth to spend the active decision making. The real problem isn't what the market is doing. The problem is that your portfolio doesn't have a clear job description tied to time. Let me reframe an old adage in investing: diversification. We've all heard it. Spread across different asset classes, stocks, bonds, alternatives, and you'll be protected. But here's the problem with that framing in today's markets. When fear is the driver and a single headline reprices expectations on growth, inflation, interest rates, and sentiment all at once, traditional asset class diversification doesn't always cushion the way investors expect it to. Stocks and bonds, for example, are often described as counterbalancing. But when inflation fears are part of the story, they can both fall together because they're sensitive to rising rates. So the hedge you thought you had may not show up when you need it most. So the better framework isn't asset class diversification alone, it's time horizon diversification. This is a principle at the core of how we build portfolios at Tailored Wealth. We call it life-driven investing. And the core idea is this: your portfolio isn't a plan. It's a tool that serves your plan. Risk isn't volatility. Risk is not having money when you need it. And your investments should have a job description tied to a date and a purpose, not just an asset class. Here's the bridge I want you to hold on to before we get into the framework. Before you try to protect your portfolio from the headlines, make sure the next 24 months of your life are protected first. Now let me walk you through the 5-step framework that we use. I'll show you how to frame this and how it changes the way that volatility feels. And if you'd like details on how this could work within your specific financial plan, feel free to book a free wealth strategy call in the link below. Okay, step 1, Fund the next 12 to 24 months of your life. This is your emotional shock absorber. And it's the single most important thing you can do to reduce reactive decision making in a volatile market. We're talking about your lifestyle spending that can't be deferred. No large expenses like tuition, a home remodel, or a large purchase you've been planning. Any career transition runway that's on your horizon, and optional money. These are funds that give you the freedom to act on an opportunity or absorb a surprise without having to sell long-term investments at the wrong time. When the next 12 to 24 months are funded in stable, accessible capital, the long-term portfolio can do its job, which is compounding without being interrupted. Step 2 is separate your money by time horizon. Think about it in 4 bands. 0 to 2 years, the goal is stability and liquidity. Think cash, money markets, and short duration fixed income. 3 to 5 years is about conservative income and near-term goals, funding college tuition, planning for a real estate purchase, or beginning the early phases of a hybrid retirement. 6 to 10 years is moderate growth. This is when you can start accepting more market movement because you've got the time horizon to absorb it. 10 plus years is long-term compounding. This is the part of your portfolio that gets to be really growth focused. It can ride out corrections and geopolitical uncertainty because it doesn't have a short-term job to do. Which brings us to step 3. Give each sleeve a written job. This is where the framework gets concrete. Cash equals access. Conservative income equals stability and drawdown management. Equities equal long-term compounding. And alternatives or hedges for the right investor may have a unique and distinct purpose in your plan. But don't give one asset 5 different jobs because you read 3 conflicting articles about gold or commodities or alternative income strategies. Different goals require different tools. And if a position doesn't have a written job tied to a specific time horizon and outcome, you should ask, why is it there? One of our clients, I'll call him Steve, is a 47-year-old VP at a large technology company. He has RSUs vesting quarterly, a meaningful balance across 401ks and taxable accounts, a child that's starting college in 2 years, and a wife that's also a senior executive. And they've been considering whether one of them should step back from full-time work in the next 3 to 4 years. And before we worked together, their portfolio looked diversified on paper, but when we mapped it against his actual timeline, there was almost no separation between his near-term obligations and his long-term compounding capital. Everything was riding the same wave. And when markets dropped, it felt like his daughter's tuition and his early job transition were at risk at the same time because functionally they weren't. Once we built out the 4 bands, pre-funded the college costs, and gave each other sleeve a written job description tied to their timeline, the next market correction felt completely different. The long-term money kept compounding, and the short-term money was protected. And most importantly, Steve stopped checking the market every morning. Step 4 is to write these rules before stress arrives. This is the step that most investors skip, and it's the one that pays the biggest dividend when volatility shows up. Before the market moves, before the headlines get loud, establish your decision rules. How and when do you refill near-term buckets when they get drawn down? What are your rebalancing thresholds? AKA, what are the triggers, not emotional reactions, that prompt a portfolio adjustment? What are your concentration limits for any single position, particularly if you own large amounts of company stock? And what's the policy for diversifying equity compensation as it vests? Think of these as the policies in the middle, not rigid rules that ignore context, but clear, pre-committed guidelines that prevent emotion from driving the bus. No drama, no reactivity, just a system that keeps running even when the headlines don't cooperate. Step 5 is review quarterly, not emotionally. We run quarterly strategy sessions with every client, and I like to think of these as board meetings for your personal finances. We find that quarterly is the perfect rhythm because it's not so short term that it's reactive to news, but it's also frequent enough to adjust for changes in your life and the overall economy. And in these sessions, we review and ensure that each band still has the right funding level. And we check whether the plan is shifted because of something in your life, not just the news. This rhythm is what separates a living financial plan from a set it and forget it portfolio, and it keeps you in the driver's seat. From what I've seen, here's what changes when you build a portfolio and a plan this way. The headlines don't need to get quieter for you to feel calm. Your long term capital gets to stay long term, compounding toward the life you're building and uninterrupted by short term noise. And your near term life is funded and protected. So a bad quarter doesn't force a bad decision. And the question you're asking yourself shifts. You stop asking, what should I be doing because of this headline? And you start asking, is each dollar still doing the job that it was assigned to do? And that's a fundamentally different relationship with your portfolio and with uncertainty as a whole. Because real wealth isn't a portfolio that never moves. It's a financial life where market noise doesn't hijack your decisions. And when your next few years are funded and your long-term capital has time, you get something most people never build: the freedom to live your life without waiting for headlines to give you permission. And that's the actual goal. Not beating the news cycle, but making it way less relevant to the life you're building. Okay, quick recap. If your portfolio needs calm headlines to work, the structure needs attention, not the market. And the fix is time horizon diversification, separating short-term life needs from long-term growth capital. Also, give each dollar a written job and build decision rules before stress arrives. That's the framework that turns short-term volatility into background noise. And if you want the complete guide on how to map every dollar to your specific timeline, check out our life-driven investing video. That's where I review the complete framework. Thanks for watching, and I'll see you in the next one.